You've got companies like Uber, Airbnb, they're leaking money like no tomorrow. Even though they're losing money, they're still worth billions and billions of dollars.
Because they can keep raising if they needed to.
Correct.
Yeah.
What are you trying to achieve? Like, really give that some good thought. The ultimate goal is not just profitability, right? But it's also how do we increase the valuation as high as possible.
If you own 100% of the equity, it's probably something you don't think about. But when you start to bring on partners and it evolves, can you talk a little bit about that?
Sure. So first thing first,
Michael, welcome to the podcast.
thanks for having me, mate.
We've also been talking quite a bit lately, and you're someone who I've been bouncing and soundboarding some ideas with about my own companies, and you've been on a unique journey yourself with obviously starting an initial business, but also kind of venturing off, and now you're in a situation where you own equity in multiple companies, quite a few, if we were to kind of run through them. But what I'm mostly excited about today is to talk to you about the idea of raising capital. I think for people in business who haven't had successful businesses prior to this, to the one that they've got now, whether it's an idea or whether it's a business in their first 1 to 2 to 3 years, raising capital is just something you don't even think about. You think, I need this thing to explode. Yeah. And then it's just kind of scaling it up. And that's kind of how they think about it, which, is one way to do it. But what I'm excited to chat about today is how do we raise capital? And I think the first thing I would love to start with is, can you just explain equity in a business? And that sounds really simple.
Sure.
But the idea of, when I start a business, I start a company, I own 100% of the equity.
Yep.
Can you talk a little bit about that? What is equity?
Sure.
And then we can kind of evolve from there.
Sure. So first thing first, I think people get confused when it comes to equity and raising capital and so forth. So I'm very glad that you brought up this topic. I think it's important. In the simplest form, when you start a company, right, you open a corporate structure, okay, which means that you as a person or an entity that you own becomes a shareholder of that entity. And what that means is you own a piece of the company, if not all the company. So let's say, for example, you start a company tomorrow and you started it solo, you might own 100% of the business, okay? But let's say you started a business tomorrow or an entity or corporate structure with someone else, then you might go 50-50, for example. And then what that would mean is that you would own 50% of the company, that other person owns 50% of the company at its simplest form, okay? Now, obviously that comes into valuation plays and we can talk about that in more detail. But in terms of corporate structure, it's literally an ownership of an entity, which essentially is a vehicle to allow you to run a business and do what you need to do.
And then, so when we talk about equity, what are some of the benefits of, say, equity? If I own equity in a company, what benefits as an owner do I get? And again, I know this sounds really simple, but if you own 100% of the equity, it's probably something you don't think about. But when you start to bring on partners and it evolves, can you talk a little bit about that?
Sure. So first thing first, when you start a new entity, there's a few different ways to own equity. One is you can start your own company and then you start a new entity. It's worth nothing at the start. And then ultimately you build the price of the share and it becomes more valuable and more valuable. And that's through creating sales, creating partnerships, bringing the right people to the table, building IP, intellectual property in the business. And so that's taking something from the ground, building it up. Another way is acquiring a business. So you might acquire a company that might be valued at $2 million and you go, I want to buy 50% of this business. You make an offer to buy that business. You pay someone for those shares in terms of what you think the shares are worth, and you come to negotiation, you agree, and you take over that equity stake in that business. And the ultimate goal, and where there's an opportunity for people to do well from an equity component, is build something and then exit through like a capital event, right? And that's where you build something, increase the share price, exit, and then walk away. Or you can build something that has a dividend payout, for example, and that, you pay yourself dividends quarterly or monthly or whatever you choose as a board, etc., to be able to distribute not only, capital growth, but also cash flow, right? And so I think when we talk about equity, is you might start off with, and we'll talk about valuations and raising capital, but you might start off with a 50-50 ownership, and then you could get diluted as you raise capital into the business because you're distributing more shares across. So there's essentially a certain amount of shares on issue. So you might have 120,000 shares on issue or 1.2 million shares on issue, whatever you agree on or whatever the accountant tells you to do. And then ultimately you can issue more shares, okay? Or you can give away the shares that you currently have, right? Again, not financial advice, but an accountant can tell you what the best structure is. And every time you raise capital, you get diluted essentially.
Let's run through an example, I think, to give people a bit of insight. So let's say I've got $1 million business. It's doing $1 million in, let's just say, recurring revenue every year. And then I've got a 50-50 partner. I own 50% of the, let's use me and you. I own 50% of the shares. You own 50% of the shares. Can we talk about, can we then dive into potential valuations?
Sure.
Right? Just on scenario. Let's create a scenario out of it. And then also potential distributions and just actually run our business that we own together now through that.
Sure. So you've got valuation is a funny and interesting one because you've got startup valuation, which is all based on future forecasting 99% of the time, and obviously who's involved in the business and which industry it's in, how it is the industry, timing, so forth and so on, and future forecasting on what you think you can achieve and delivering on those achievements. And then you've got paper valuation, which is a business that's been running, it's doing X amount in profit. Their average industry value is 2 to 7x multiple. I'm happy to come in and pay 2x multiple on your profit. Okay. So if we talk about startup valuation, it's all about future forecasting and what an investor is willing to pay for that value. Okay. And so you might have, let's call it a tech play. Okay. And that tech play has done $1 million in revenue, right? Traditionally speaking, if we looked at 12 to 24 months ago, an investor or VC fund or high net worth family or a high net worth individual will come in and pay you or invest in your company based on a 10 to 15x multiple on your revenue, right? Up to 19 multiple back 24 months ago when stocks were, or tech companies were high valuations, right? Now they've pulled back to probably about 6x multiple on your revenue. Now, if it's not a tech play, that's why I love tech plays in particular, is because they have such a high multiple. If it's not a tech play, I bought a gin and vodka distillery recently. We paid a 3x multiple on EBITDA, right? And so we bought in at that price. We came in and we're not going to bring capital in because we're not looking to accelerate the growth. We're just happy. We are accelerating growth through the profit that comes into the business. So you've got startup valuation, which is future forecasting, what an investor's willing to pay for it. And then you've got
at a bigger multiple
if it's a tech play majority of the time. But it's almost like 99% of VCs will look at tech, right? Startup valuation in terms of tech, right? If you've got a product, some VCs will look at it, some not, depending on the industry, depending if it's a hot market. I own another company called Bestop. We're in sustainability. Sustainability is interesting to VCs at the moment, so they'll look at it, right?
Yeah, it's a trend.
Yeah, but they might not pay a 15x multiple. They might pay a 3 to 7x multiple, right?
Can you just explain EBITDA too as well?
Yeah, so profit after tax. So it's your bottom line, basically. Okay, so obviously you've got your revenue. Let's call it $1 million, okay? And you spend 50% of that on all expenses. You've paid your tax, which might be at, let's call it, at the moment, the tax rate, I think, is 23% for businesses, and it's your bottom line of what's left. And then that's what someone will pay you, basically.
Yeah.
So let's say your bottom line of what's left is 100 grand in the kitty. Then if I was to come and acquire your company, right? And it's a tech play, for example, I might pay you a 10x multiple on your profits, so $1 million, for example, right? Or you might convince me that it's got a bigger opportunity if we were to bring the right people, blah, 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 and you might negotiate a 15x multiple, When you're raising cap, I want you to think about startups for a second, because the ultimate goal is not just profitability, right? But it's also how do we increase the valuation as high as possible, right? So I'll give you an example. Let's say, for example, you and I started this tech venture, and tomorrow I said to you, I'm going to bring in Elon Musk, who's going to run this company, right?
Mm-hmm.
All of a sudden, from $1 million valuation, just based on who I brought to the table, it'd be worth a lot more because of the credibility of that person and what they're able to deliver. So early on in your journey, what VCs are looking for, and we'll talk about the pitch, I'm sure, but is backing you as a person, right? And who you are as an individual, because they don't have a lot of data to go off if you don't have an established business to be going for 5 years. And then obviously the opportunity in that industry and what they think you can do to deliver, right? And so to your point around multiples and cap raising and all that kind of stuff, basically you should focus on how do I increase the size of the pie. I'm okay to give away some of my shareholding because the size of the pie will be higher. So in an Afterpay example, right, the guys started with 50% each when the business was worth nothing, right? And they walked away with 7% each when they sold the business, but they sold it for 39 billion. So they walked away with 2.5 billion. So every cap raise that they did and eventually listing on the ASX, the value of the share of that share always increased and increased, and eventually you exit, and that's where you make your money, right? That's sort of at a high level, trying to sort of break it down.
Yeah, and then so can we talk about equity and cash flow then, and distributions and that model?
Sure. So that's sort of like outside startups, let's call it. You've got an established business, you're doing $10 million in revenue, your profit is sitting at $1 million. I come in and I want to buy your business, and you haven't cap raised or anything. You've literally built the business and you own 50-50 at the moment. I pay you, let's call it a 3x multiple on your profit, which is $1 million, as in $1 million in profit, $3 million purchase.
Mm-hmm.
Give you $3 million, you split 1.5, I split 1.5. Obviously there's capital gains event in terms of tax that you have to pay on those funds, etc. So you've got to factor that in. And then you walk away with that. Or you might say, actually, instead of selling the business, I think I can get it from 10 million in revenue to 20 million, but make it 30% more profitable. And then your bottom line becomes higher, and then you sell at a higher, higher exit price and so forth and so on.
What I want people to understand is that like what we're really talking about here fundamentally is the idea of buying and selling companies, right? But then there's also another arm to that, which is like, let's say me and you started a business together.
Yeah.
No one's bought in yet.
Yeah.
We're just 50-50. We started, like, let's say Afterpay, but cash flow business, right? The idea that we own 50% of the equity is that whenever we make a distribution, whatever that distribution is decided by the company, we take 50-50 in that. Or our shares get a certain distribution. We own 50% of each of those. Because I think that's really important. Like, let's say you own an agency. We're going to, that's a cash flow business. A good agency will generate a good amount of profitability. Someone might come in and, like you said, they might offer to purchase part of that agency. And however many shares they want, what they're going to want is to make a return on their investment over a period of time. So like you said, let's say $10 million company making $1 million in profit. Someone comes in, they buy 50% of those shares. You're going to have to, the company, I'm sure there's structures around this, but all right, if we're making $1 million a year in profit, we're going to distribute X percent. Or, there's so many ways you can spin that. We don't need to go into that now. But then it's like whoever owns the shares in that company, there's a distribution there based on those shares.
Correct. And you might, rather than paying distributions, you might reinvest the funds into the business to increase the valuation, right? So I think it's important to take a step back and go, okay, what are we trying to achieve as a business before we get there? And so you and I might partner and we go 50-50 and we go,
we want to sell this fucking thing.
So this is the thing. Exactly. Spot on. Some people are happy to just have a cash flow business doing $1 million profit a month and they pocket $1 million a month and happy days. Some people are like, I want an exit strategy of $1 billion in the next 5 years. Or some people want to IPO and offer, their company on this to retail investors, right? So everyone wants different things. I think it's important. A lot of people go into business and they're like, they don't know what that end in mind is. And I think it's important to break down the strategy, the exit strategy on going, okay, I'm happy to exit at 100 million in 5 years. What do we need to do to get this to $100 million valuation, right?
I think that's the magic of like, you hear people, I remember like when I was 21 and I spoke to a mentor and they were like, what's your 20-year plan? What's your 5-year plan? What's your 10-year plan?
Yeah.
You're like, man, I don't fucking
No idea.
I'm like drinking beers on the weekend. Like, just fuck off, dude. You
Yeah.
know?
Yeah.
Like, I just want to make cash.
Yeah.
Right? That's
Yeah.
but then I think like the older you get and the further into business you get, you start to realize there's like mathematics that solves all of this. Like, you know, all right, we want to sell in 5 years at $100 million valuation.
Yeah.
This is where we need to be.
Yeah.
You know, in 20 years time, you know, I know there's someone I know who I would consider a mentor who, you know, owns a really successful, you know, it's a juggernaut, it's a publicly listed company.
Yeah.
And, you know, he's just succession, cash flow business to the max.
Yeah.
You know, but it's like his whole business is about generating return from that cash flow business perspective.
Yeah. Okay.
And it's just interesting that, you know, he's got 20-year plan on a business that's been around for 20 years.
Yeah.
Or, you know, I think maybe 15 years or whatever it is, been public for 5.
Yeah.
But he's still got a 20-year plan
Yeah.
of like, okay, this is where we want to be. This is where we need to get to.
Yeah.
This is what we, you know, he doesn't. And it's interesting that I think that side of it, and I think when you start a business and you haven't really been in business before, you don't think about that stuff.
Yeah.
It's like, oh, cool. Like, I've got an idea.
Yeah.
I'm going to get a product. But thinking about, do I want to be doing this for 20 years? Do I want to be doing this for 10?
Yeah.
Do I want to sell?
Yeah.
You know, do I want to exit? I think all of those things is something that you should really plan for, because you can, I mean, just as on a pure business perspective, right? You can end up in a place you don't want to be, doing shit you don't want to do, and you're just stuck.
Which you don't want to do. Like, that's the last thing you want to do, right? Because then you don't know how to revert back to why you started in the first place. So to your point around your contact who's got a publicly listed company and planning out the next 5 years, right? They have to legally report to shareholders, right? And publicly announce and make announcements. And so in his scenario, he has to do that, right? And he has to plan it out. When you own a privately, you know, owned company,
Get away with it, don't you?
You don't have to. Spot on. And
but you should.
You should. I think you should.
Yeah,
like,
it's a good exercise. And you know, it's hard as a small business because you're so in it.
Yeah.
You know, I think like that's something that's really difficult to get a hold on your reporting, your goal setting, you know, where you want to be. And but like if you can get a hold of that and you can work towards them and practice hitting those targets and doing that, it's a good practice. You know, I know that's something that we're trying to focus on internally, and it is difficult. It's not easy. You don't have a big team. You don't have assistants and these kind of things in a startup. You know, you shouldn't be paying for those things.
Exactly.
But you know, I think it's a good exercise to try and do, even if it's just on an individual level.
Yeah, absolutely. I think the other element that's very important to mention is because a lot of people don't understand. You know, you've got companies like Uber, Airbnb. You know, these companies, Netflix, right? They're leaking money like no tomorrow. So they're in a loss every month, every year, right? But they're valued at so much money. And that's because they've been able to build so much IP, such a large community of people, right? Such a large presence that is so valuable, right? And so their shares are worth so much money because they've been able to monopolize, you know? And so there's that element. Even though they're losing money, they're still worth billions and billions of dollars.
Because they can keep raising if they needed to.
Correct.
Yeah. And what that means is, just so that you're aware of that, you can keep losing money and spend more than you are bringing in or earning to add to the valuation further. Because the more you add to the valuation or the more value you're creating, which is what you just said before, all those things, you can go and raise money. It's like Elon. No one in the world would not pay Elon for any of his businesses. Like he could go and raise money in the click of a finger tomorrow if he needed to, because he's the best value creator on the planet.
100%.
Right? So I think like that's so far beyond the everyday person that's starting a business. But I think I think it's an interesting conversation.
Yeah. And again, it goes back to the point of, what are you trying to achieve? Like, really give that some good thought. Are you looking to create something that lives beyond your lifetime? Are you looking to build, like, have you got an exit plan over the next 3 to 5 years to exit your business at 100 million? If that's the case, then you have a plan of when are you cap raising, why are you cap raising, what's it for, how is that going to foresee you over the next 3 years to get to 100 million in valuation based on the fact that you're raising now and how much you're raising, what you're doing and all that kind of stuff. I see too many people raising too early, too late. And if you're raising too early, you've got an issue because you can't scale fast enough. If you're raising too late, you miss the boat. So I think it's very smart to try and work it out as much as you can. Obviously, there's always going to be changes, but at least having an end goal in mind to go, I know what I'm trying to achieve here. Let's work backwards and then let's do what we need to do to get there,
Yeah, such valuable information.
Yeah.
Michael, we're going to continue this chat into the next episode, but I just want to say a massive thank you to you. Thanks to everyone who listened into that. We're going to put some information about Michael and his stuff in the bio, and so you can definitely reach out. He's a smart guy,
Awesome.
Knows what he's doing. But I hope you guys enjoyed the episode. If you're enjoying these Learn series, we're going to keep bringing them to you because we just fundamentally, honestly, we just want to eradicate the need for a course. That's what we're trying to do with the podcast, just free information, helping, early stage business owners. So if you're enjoying it, hit the subscribe button, the follow button, leave us a review, share it with your friends. All that stuff just helps us continue to do it. So hope you enjoyed the episode. We'll see you next time.